Now, looking at the beta of the firm, which is a measure of market risk, right? It's a measure of market risk, or probably we call it as systematic risk of the firm. So, the higher is the beta, I can very well say that the systematic risk, the risk of a company with respect to the overall market, is going to be much higher. Even the way it is measured is covariance between the asset returns and the market returns divided by the variance of the market return. So, in turn with the market, in line with the market, how is the risk of the security typically changing? So, in a simple way, if the beta is very high, probably it means that the risk of the company is much higher. Now, going with this, now, if the company wants to reduce the beta, right, to become less risky, if the company wants to reduce the beta, the major thing that is available with the firm is diversify. And that too, this diversify should be in those kind of businesses which are more or less dissimilar to what is the current business that a company is into, and or probably find where the stock price movement or price movements are completely opposite, which are having a beta completely a negative kind of a beta. So whose prices move completely in the opposite direction to that of a specific company's business. This will reduce the overall beta, and at the same time a reduction in risk could also compromise on the reduction of the return. But is this kind of a diversification a really an advisable strategy from the perspective of shareholders? Will the shareholders support this kind of a move from the company? The answer is no. Any company which is trying to artificially reduce the beta probably will not be preferred by the investors, because one side we can see investors typically they have their own diversification methodologies. They are typically trying to invest in a firm under the assumption that the company clearly understands its business. It has a very clear investment strategy where it is running its business, and the investor does not have that kind of expertise in that particular business. So he wants the company to run that particular business and probably make more profits. But the artificial diversification which the company is getting into by typically diversifying its business into an industry, probably in many of the times that industry which is chosen purely from a historical data analysis and seeing where the correlation is much lesser. Based on that, if an industry is chosen, it might very well be possible that the company does not have any kind of an expertise in that particular business, and that could even increase the risk of the investors. So just for an artificial diversification and just for reducing the beta, if the company has got into some kind of a business which really is which really does not have an expertise in, probably it is going to add more and more to the risk of the investor, which means rather than paying a premium for that reduced risk, he is even willing to move out of the investment from that particular company, because it might prove costly for the investor to typically stay with this firm, as the future profits might go down drastically. And as a portfolio, the investor can maintain his own portfolio based on his understanding and assessment of the risk status. And typically, let's understand any specific company, there are some specific risks, company specific risks. Now, the investor can very well diversify these specific risks. But if at all the company is trying to diversify it by getting into a new industry altogether, it is going to reduce the overall profits of the firm, and overall the investment is going to become futile. So it is very much necessary for us to understand that reduction of the beta market risk is nowhere should nowhere be in the minds of the company, because it can very well prove more and more futile, because the investor has invested in that particular firm knowing that it is a risky firm, but he can get a slightly higher return, and to reduce his risk he can very well diversify his portfolio himself based on his risk taking capability. But if the company itself goes into that particular mechanism, then the shareholder or an investor might very well feel that his investment objective is getting damaged, his investment portfolio gets badly affected, which could imply that he can very well pull off his investments from that particular firm. So, though theoretically it looks as if the beta higher it is, the riskier it is, but a company eventually trying to reduce its beta suddenly by getting into a diversification strategy may not be typically appreciated by majority of the investors because of this reason, right?